Hello, everyone. Let's use the homework of chapter 12 to review the contents in the chapter, the responsibility of accounting centers, and also the segment reporting. Number 2 of the question, I like it because it's a continuation from the book example. So the responsibility centers for the hotel chain and how we evaluate the performance of the food and beverage department. For you to complete this assignment, we need to review the background information which offered by the question. Also, we use it in the book. So this is the variances analysis for all of the divisions and the hotels in the book by February of the year. So for flexible budget and actual results, we all have the February data and also the year to date. So means the January and February combined. Then we analyze the variances in terms of the actual number and the flexible budgets. We want to identify the favorable variances and unfavorable variances for further investigation and analysis. And I think we went over most of this stuff on the Monday's lecture, right? So you can review that for how we can roll over from the kitchen data all the way to the department, to the hotel, to the division, and the company-wide performance. And the things here, like I mentioned on the prior lecture, for favorable and unfavorable is not a definite answer yet until you come up with the reasons or explanations. Because sometimes unfavorable is not really controlled by the department or the managers. It may be from some external uncontrollable reasons, like the overall environment or like weather or disasters like the COVID-19. So you are not really directly do performance evaluation by the simple numbers we are presenting here without additional analysis. Okay, so just something just to be careful. And because we focus on one line of the operations or one line of the responsibility centers. So if we look for the kitchen, that's only a cost center, right? Because the kitchen is responsible for the cost to provide the food and beverage. Even the other two functions, they serve the guests or customers directly. So the kitchen is providing food to the restaurants and banquets and catering services. So the other two functions, they are defined probably like a revenue center. And combined, the food and beverage, the whole department is a profit center. So combined with the revenue, two revenue centers and one cost center, that's the overall condition for the food and beverage department. Then going upper, the hotel itself is also a upper level profit center. Then the divisions are small investment center, and then the overall company is a large investment center. We just have a review for the organizational structure of the company you are continue to working on. So now let's get back to the question. Now we add the March data into the analysis. So February passed. Now we add the budget information for March and the actual operational results for the two revenue centers and the kitchen, the cost center. So for the banquets and the restaurants, we can directly use the data in the following table for analysis, their budgets and actual. But the food, the kitchen cost, we need to organize them together so we can have an overall idea for the kitchen performance in March. So before you can roll up to the department, we need to work on the bottom parts of the table first. And we can put the monthly. So first you put the monthly, the budget and actual. So based upon what's offered in the background information. So monthly comparison. The year to date, we need to open that exhibit. Okay, like the exhibit. So we can add the March data to the year to date. So for year to date, we should have January, February, and March. Okay, so we add the year to date from the exhibit plus the new month, which is March. So that's where you got the year to date data. Then we can compare the differences for the March only, the variances, and also for year to date variances. Because these are all cost data, right? So when you use the unfavorable or favorable, we are comparing the actual to the flexible. If the cost actual larger than the budgets, that's unfavorable. But if you have revenue centers, the direction of favorable and unfavorable is opposite to the cost items. When the actual revenue larger than the budgeted revenue, we have favorable, right? Like the banquet. But the restaurants, the actual monthly data and the yearly data, so it's all unfavorable. But those you copy from the background and also add to the year to date. So we got the kitchen cost data, then put it with the two revenue centers. And now you get the total performance comparison for the whole food and beverage department. So that's the total profit. So overall department, we are a profit center, but the profit coming from two revenue centers and one cost center. So, but combined, we still have unfavorable profit for the month and unfavorable for year to date. So that's the food and beverage. So for responsibility centers and the performance evaluation using the flexible budget, that's normally a series of analysis and reports. Okay, so we are combining the budgeting and also the responsibility accounting centers and also your performance evaluations together. Okay, so that's for, but here we haven't really touched on the KPI. Like you may have some special KPI for departments or like divisions. Okay, those can be in addition to this variances analysis. Then the next question is about the segment reporting, which this segment I think mostly fits for a profit center. The segment reporting, because you can tell we are using the contribution margin income statement, which we introduced with the CVP analysis. So you are comparing the net income or net loss for the whole company and then divided into the segments or divisions. So the key stuff for segment income statement is separates the fixed cost, because when we introduce the CVP, we are doing the company-wide analysis. So when we're looking for the fixed cost, we are looking for the overall fixed cost, including all of the departments and the divisions operations. But to separate the performance for each division or segment from the company-wide, in the segment reports, we need to have information of the fixed cost break down into controllable. So when you read the book, a controllable fixed expense by each segment, and then the common fixed cost normally attributable to the headquarters. So those or sometimes they call it allocated fixed overhead or fixed expense. And also you have another category they call fixed expense, traceable to segment but controllable by other departments. Or like, so we can take a look, okay, for this. So the key point in segment reporting is separate the fixed expense by the natures of three type of fixed expense. So the first level, traceable and controllable by each segment. So traceable is incurred for the segment and it can be controlled by the segment manager. For example, the office expenses for the segment. Then second level, fixed expense, traceable to the segment, but controllable by others. For example, the overall utility cost for the building or for the factory facilities, right? So we may have three different product lines or three segments using the common utilities, right? So it's traceable. We do use the utilities, but it's not really controlled by my segment or department, right? So there's some allocation involved. Then finally, the common fixed expense not traceable to each segment. So company-wide overhead fixed expenses. So for the common fixed expenses is only listed under the company-wide column, but not break down and allocate to each segment. Okay, so for the segment reporting, we stop here, we call segment margin. So here they have a longer name, so profit margin traceable to segment, but a simple name will be segment margin. So, but some of like the practice or assignment students did it before, they continue here, allocate the common fixed cost to each segment. Then you can see they may have different like profit or losses compared to the segment margin we stop here. But that's a wrong format. We talk about this similarly in the job or maintain a product line or segment in chapter 14, the special decisions. So when you evaluate the actual profit or loss for a segment, you should stop at the segment margin. Do not bring the common fixed expense because that may give you a wrong idea about the true performance of the segment. So now let's get back to this example. Okay, this is a cable service company, right? So for example, Xfinity used to call it Comcast, right? So all other type of internet or cable providers. They have three regional segments, okay, metro, suburb, and outlying. That's normally the segment is geographical related. So when we prepare the segment reporting, compare with the company-wide, and so we have the revenue breakdown and variable expense breakdown, right? Then you got the segment contribution margin. So right now, the contribution margin of the company-wide is the addition for all of the three segments. Then we minus the first layer of the fixed expense, controllable and traceable to that segment. For example, your manager's salary, your office expenses, and other maybe depreciation of the equipment or like building, maybe vehicles, okay, but like for the physical assets. So first layer, we got the profit margin, be careful, controllable by the segment manager. But that's not the segment margin yet. For the segment margin, we need to minus the second layer of the fixed expense, or traceable to the segment, but kind of allocated to the 3 departments, like the utility expenses or some common fixed expense, but still traceable, like used by the 3 segments. Okay, so we got a breakdown, but you need to allocate, use some cost allocation basis. So now you got the country segment margin or segment margin. So the segment reports will stop here for the 3 segments. But for the company-wide column, you continue minus the total fixed expense common. Oh, that's no need to break down, like your overall management fixed expenses or marketing sales expenses overall fixed. Then we got the net income before the tax and minus income tax. That's the final company-wide net income. But again, the focus of the new materials we are emphasizing here is you can see where we stop for the segment margin. And then the net income for company-wide, you continue after the segment margin. And based upon the segment margin statement, we also can do other CVP analysis. For example, the break-even analysis for each segment. In that case, when you use the break-even formula, the fixed expense divided by the unit contribution margin, then your fixed expense should be only the first 2 layers for each segment. Okay, their break-even point sales. So use the layer 1 and layer 2 divided by the unit contribution margin by that segment. So you got the break-even point for each segment. And if you add all of them together, that won't be the company-wide break-even, because for company-wide, you still have some common fixed expense to be covered by the total contribution margin. Oh, but just I'm saying, so when you do the break-even, you can have the overall company, and you also can do on the segment levels. And the next question is some KPI you can use for like, the burn rate, cash runaway, especially for some cash management like issues. The calculation is not hard, but you can see how this can be combined with some other performance evaluations. Okay, so we can improve the efficiency internally. Okay, internally, like when you design your balance scorecard. So what are the operational efficiency measurements? Like the KPI, we have financial performance. Then you also have some like internal efficiency KPIs. Okay, these can be good examples. So I will stop here for the homework, but that's pretty much about chapter 12.